you cannot go it alone with private equity. It's just, I will tell you that you will be screwed in some way. I mean, you will. And they will just take advantage of what you don't know. And so that's what they'll do. Most founders, I find, don't even look at their balance sheet. And so that's a problem, because most of the time the problems on the balance sheet actually reduce your EBITDA. So you must go look at your balance sheet, look at your financial story, hire somebody. Oftentimes you don't have, your accountant is compliance based. So they're not designed to help you. So go out and get help.
Behind every value creation plan, there's a data problem nobody wants to talk about. Fragmented systems, metrics nobody trusts, and decisions made on gut feel dressed up as analysis. Welcome to the PE Data Guy. Each week, host Graham Crawford talks to the operating partners, advisors, and practitioners who are doing the work inside portfolio companies. If you care about what actually drives returns in the market, then you're in the right place. The PE Data Guy starts now. Holli Moeini is a CPA and M&A advisor who spent her corporate career as a CFO, scaling companies from 30 million to 200 million through acquisitions. She has driven phenomenal surges in stock prices in her career. Then, she left corporate and hung out her own shingle, and now she sits on the other side of the table. She helps founders and sellers go up against PE buyers and actually protect their value. Holli's book, Find the Missing Millions in M&A, just came out, and today we're going to talk about the crime scenes where money quietly disappears in deals, and why the financial story your data is telling might not be the one you think it's telling. Welcome to the show, Holli. How are you doing?
I'm excellent, Bram. Thank you so much for having me. I'm excited to be here and talk about crime scenes.
Oh, all about the crime scenes. You and I talked about this before. Like, it deserves more than a throwaway sentence of left corporate to hang out her own shingle. And I know because I've done it myself, right? So
Right.
Talk to me a bit more about that decision, what drove that decision, and how you feel about it now.
Oh, I'm so happy I did it. I mean, you are too, I'm sure. Like, it was, that was a decision. That was probably one of the hardest decisions I've made, because I spent my whole entire career there, and then you are kind of locked in with money. And
Those
so,
RSUs weigh heavy, don't they?
yeah. But what I found, and I think, I don't want to put words in your mouth, but we talked a little bit about this. What I found is that after 35 years, I've been doing this for a long time, I had gained so much wisdom that I really wasn't growing anymore in my position. And I realized that I was getting bored. It was like the same old thing over and over again. And I actually don't think that's good for an organization. You need to move on to another organization and start it all over again, or you need to get out and let somebody else come in. And so it took about a year for me to get out of my company and find a replacement and all of that. And that was a great process. And I'm so happy I did it, but I didn't plan. So the one thing I'd say for folks, I just thought, oh, I'll just go and it'll be fine. I've got this little parachute. I can parachute out a little while. And I didn't plan anything. And so I would just say, plan something if you're going to do it. That was the most painful thing, was that I didn't plan anything. Then I'm like wandering in the wilderness thinking, well, I need to make money. What am I going to do? But I'm glad I did it. I'm glad I wandered. And then I ended up in a place where it was just natural. I didn't realize like the small to mid market needed so much resources in a time of private equity and so much money out there. They need help, and so therefore I hung up my shingle. I was uniquely qualified. So these things just happen, right?
Yeah, it's magical, and it sounds like you've found something that's the perfect fit for all of the skills and experience, as well as the passion that you have for it as well.
Yeah.
I love it. And a book as well. What an exciting time to be putting a book out.
Yeah.
Let's talk about some of the things from the book. So most people in M&A, private equity, talk about value leakage or diligence findings or things that sound nice on a board deck, but you call them crime scenes. And you chose that word specifically, those two words specifically, crime scenes. So can you walk us through the different places that money's being lost or given away in transactions, and why that language matters?
Yeah, I mean, I really chose that language because I found that in an M&A deal, money moves through the whole entire journey, and it either comes to you or it leaves you in five common moments in every deal, on the buy side and the sell side. And so we operate on the same crime scene. So the person that doesn't understand what's happening loses. And so before you step out on the terrain on either side, you better know all the crime scenes and what's going to happen. So that's the reason why I said, and there's always a trace that's left. And sometimes you don't know that you're actually losing the money. But there's traces that are left. So let's go through them.
And let me guess, the victims in these crimes, are you, like, I'm guessing if there's a lack of knowledge for one of these five situations, that it's not the private equity firm that's suffering from the lack of knowledge, right?
No, it's never the private equity firm. It's always on the sell side. But yes, that's exactly right. The lack of knowledge is the person that will lose here. So crime scene one, and this is a very big crime scene. It is the financial story. And so as sellers, we've got sellers that aren't prepared. Only 70%, only 30% prepare. That's what's estimated. 70% don't prepare.
Don't prepare at all.
No, they call and they send their financials. And so then you have only 70 or 20 to 30% actually sell. So 70 to 80% don't sell. So they're doing something wrong. So the first thing that they're doing wrong, not only are they missing millions, but they're not even getting to the table, right? So the first crime scene is the financial story, and that happens on both sides of the deck. But if it's private equity, you've got someone that knows what they're doing there. So you got to tell your story. You have to own that. When you are looking at selling, you sell in a multiple range. So if you get to the table, you sell in a multiple range. The cleaner your data is, okay, you like that,
I do like that.
The cleaner, and that is a true statement. The cleaner the data is, the better you are in diligence. What happens most, even if you get to the table, get to an LOI, when you get to diligence, most crumble because the financial story doesn't withstand scrutiny, right? It doesn't get it gets pressure tested. So this is a really important thing to do. You're going to maximize your value. Private equity won't maximize that, and we can talk about that more, but there are certain levers that private equity uses that sellers do not use, and that's like proper accounting. When they call and you send them your cash basis records, that will be the lowest value. So financial story is a big crime scene. The second crime scene, it sounds really boring. It's not. Working capital.
Okay.
That is a crime scene. So sellers, hear me now. You must put working capital in your price. So what happens in the mid-market is your sophisticated buyer will give you a price, and they will in that price assume you are giving some level of working capital. What is that? That's your accounts receivable, less your payables, whatever else you have in your current assets. Usually you take cash. And so what happens in this crime scene is that working capital becomes a situation where sellers think they're getting a haircut. They're like, well, I made that AR, it's mine. And we're like, no, actually, what you have to think about is if I pay a market multiple for your company and I give you that check at closing, and then the employees need to be paid the very same week.
Exactly.
Where's the cash? Okay, so it's this thing that and
that's that seems like a reasonable position to take, right? It's just a lack of understanding. That's not an unreasonable position from a buyer, is it?
It's true, but I think what's happened is that historically, sellers and buyers would trade without working capital in the small markets. And then private equities come in, they've changed the rules. Now, in big company buy and sell, you had to always deliver. In this market, so you have brokers still saying, you don't get working capital with the price, but they have a market value price.
Right.
So sellers, like, you have to, here's the other thing. Nobody agrees on what working capital is. So you need a professional to come in and help you, because private equity will come in and they'll typically say 3 months average working capital. That is a historical working capital. That's a lazy way of doing it, and it could cost you millions. And depending on your industry, depending on seasonality, depending on if you carry more working capital than you really need, blah, blah, blah. Okay, so enough is said about this, but you must get help on this one. You will lose millions. I had a situation where we were closing an 8-figure deal, and it was the night before closing, and I'm with the seller, and the seller is saying, hey, I've got literally $1 million worth of work that I haven't billed for. And I'm like, well, what are we going to do? We're closing. So yes. I need to get it on the balance sheet, right? I got to get it. My closing balance sheet is very important. And I go, let's call them up. Let's ring them and see how they want us to handle this. Well, we ring them in Zoom, so we're staring at 4 people across from us, and they were like, oh, you don't get that. And we were literally closing the next morning. The wire was queued up. And I was like, well, what do you mean we earned that? I'm like, what? And I'm on the sell side, of course, and I'm sitting there going, well, that's not right. We earned that revenue. And they said, you actually will be in violation of the covenants and the reps and warranties of your... And I said, well, then we're going to bill all night. They said, if you do that, because I said, we're going to bill all night. We're going to bill all night until we get it done. Or we're going to delay closing. Nobody wants to hear that, by the way. Okay, that's like a bad word.
The worst,
that's a 4-letter,
the biggest stick in the room,
yeah. And so they went away. We went away. We told we talked to, you always have to talk to your attorney, get a good M&A attorney. And we came back and they said, well, yeah, you can do it. It was $1 million. And the seller was like, I wouldn't even have known they were screwing me over. This is like, you cannot go it alone with private equity. It's just, I will tell you that you will be screwed in some way. I mean, you will. And they will just take advantage of what you don't know. And so that's what they'll do. And so that's crime scene 2. We talked a lot about that.
Yeah, can we go back to number 1, by the way? Because again, I think I'm super invested in this one, as you say. And I think I'd love for folks listening to get the advice that you have to dispense on it. When I started my company, getting an accountant so that the financials were was the first thing that I did, because I know smart people like you, right? Who say, "Hey, this is a very good idea," and I wanted I wanted that data to be good. My one of the things that pops up and people talk about it, including me, right, is you can find yourself in this situation, when you've grown to a certain scale, that you might get different numbers on revenue. Right. So sales or operations or marketing might, if you say, what was the revenue this month, they might give you a different answer. Now, naturally, people would say, well, that's a bad thing, and it raises doubts and questions and uncertainty. But I argue back that there could also be very good reasons that people would consider that differently, because there could be a campaign window for marketing, there could be a sales cycle for sales, that could be, and there's all sorts of reasons. So I always tell companies, it's fine for the numbers to be different, as long as you are very well documented, very well governed about how those numbers are derived and why they are different and why it's correct that they are different. Then that is fine. That is absolutely fine. It's not about everything being perfect and adding up to the cent. It's about it being well governed and well defined. So what holes do people fall into with financials? Is it just poor care of records and they end up losing money off the price for that? Is it what traps do people fall into?
Yeah, so I love that about what you're saying about data, because that is true in all organizations. Just because the financials are one thing, there are different measurements happening everywhere else. When you go to market, you need to curate your data. You also have to curate who's talking to whom. And so we used to do this back in the olden days. Our auditors would come in and they'd be like, we want to talk to select people in your organization. And the fear in the CFO's eyes are like, oh my gosh, okay, not because you're worried about, you're not worried about there's nothing going on, but nefarious going on, but you don't know what they're going to say. And then it causes more audit and more whatever, more challenges. So I 100% agree with you. So going out to market, you curate your data. So when I take a company to market or get that ready for the broker, what I do is I look 3 years back and I make sure that all the data is in a package. So and the data the data is going to be, and we'll talk about this, I'm sure, is the adjusted EBITDA. So I'm maximizing that value, but I'm showing data that supports that. And so I read a lot of books around private equity saying they don't give you credit for ad backs, they don't blah blah, get your personal expenses out of there. And I've actually never had anybody say no to my ad backs. And because they're documented with data, they're curated, so you get a package. And then once they go into a Q of E and they hand that over to their Q of E folks, then everything gets dissected. And that's when data really matters. And that's usually when, that's my crime scene 3, actually, is
here we
diligence.
Go. Good lead in.
That was an accidental lead in. Excellent. we're going this morning. So that is a lead into diligence, where most of the deals die here, as they should, because the detail and the data behind it doesn't match. But and so that is and they will scrutinize every level of detail, as you know. Yeah.
And I say this to clients, and you've been involved in more transactions than me, so this may be different, but the advice I often give is, if you're in a tight, high pressure situation and the data doesn't match during the diligence, then you might imagine, founder, CEO person, that they'll give you a pass and say, you go away, like take a month to sort your data out and come back, and then we'll go through the price. When actually what's more likely to happen, I believe, is here's the discount we're taking because of the data risk.
Yeah, I mean, that's absolutely true. There's a discount or there's a walk away.
Oh, even worse, yeah.
Yeah, there's a walk away, because I can't. So you have to think of diligence as they're looking at you, pressure testing you to make sure that after day 1 of close, they can count on that cash flow. So the messier your records are, the more risk goes into your data. And the more risk that goes into your data, you're right. There's 2 things that happen. One is, if you're on everybody's getting priced on multiples right now, and it's a range of multiples. It's not a multiple, it's a range. So you want to be on the high range. And so what you're saying is that what happens when they look at the data is you go to the low range, and that is absolutely high. So that's your discount, all right? Or they just say, hey, this is too risky, I'm out. Those are the 2 options.
Yeah, and I quote this, and honestly, I think it's conservative, but the difference between bad data and good data, and of course, there's a whole spectrum of bad and good within those 2 definitions, but that can be up to 0.5 of a multiple, like, difference just from having good data, and I'm sure it's probably more than that.
I think it's more than that. It's hard. That is a hard statistic to understand, but it is the foundation with which everything happens, for starters, whether it's a yes or a no, and then it is the foundation of your multiples. Now, everything goes into, when we look at a multiple range, there's more than that, just data comes into that. It's your leadership team. It's your revenue quality. It's a lot of things that aren't really just data, your brand, these types of things. Even your corporate office looking nice, they come in, your systems, your processes, all of those things put you up on the high end of the scale, because it's in terms of risk. They are paying a higher multiple for companies that are less risky. And in the small to mid market, you're a shining beacon if you have all those things in place, and they want you. And so they will come with a higher multiple, for sure.
Absolutely. Certainly my experience across many, many companies in small to mid market is difficult data is the rule and not the exception, right? The true exception is data that's very well tied up, and with one exception, I would say. So I think you and I might have talked about this. Fintech, I'd say, is an exception, because fintechs are often started by people with technology and data backgrounds, and are such a highly regulated industry that very well controlled, high quality, well governed, traceable data is a minimum for entering into that market. So I actually found, as a vertical, like that should probably be the gold standard for everybody.
Absolutely.
To shoot for. So there's my advice for the day that I'll give out for free. Even if you're not in fintech, behave like you're a fintech, and your multiple will probably increase.
Well, I love it. So the point is that founders should bring somebody in to help them. Oftentimes founders don't have resources in place. it is worth your time and effort to do that. It will pay off big time at exit. So bring somebody in to help you with your data. That is your foundation.
I'm definitely not going to dispute that one.
So that's number 3.
Number 3, right.
Okay.
Crime scene number 4.
So crime scene 4 are earn-outs. Okay. I think they're widely misunderstood. Sellers hate them. Buyers love them. It's, you're shifting risk to the seller. And the reason why I love them so much, and as a buyer, I use them in a way that I want to make sure the seller's motivated and that they're going to earn that earn out. So what would I tell sellers to make sure? This is a tricky trap for sellers. And here's the reason why, is that oftentimes when you sell to private equity, you're not in charge anymore.
Yeah.
And then the legal language of what you're measured on is a problem. And then data. I'm going to talk about data here. I'm going to talk about data more here than ever.
You're talking about data more than me.
The data. Okay, so what happens when you move to private equity? The data ends up, they extract it out of your system where you're used to and put it in a new system. So you've got data that you're not sure about, measurables that you're not sure about, and control that you're not sure about. That is like, I'm not getting my earn out, right? That's a classic case. So what I do, I call it the 3 C's. The first thing is you have to have clarity. So in the earn out is clarity, control, and cadence. So what I mean by that is you have to be able to control whatever you're measured on. You have to have a cadence. You don't wait till the end and say, hey, am I meeting my earn out? And you have to see the data, right? So let's go back to clarity. That's the very first fall point here. I had a seller who had about 20% of their purchase price, which is a lot of money, in an earn out, and he was going to be measured on net revenue. That sounds really easy, right? Okay, every founder can get their arm around net revenue. The definition of that, this is where the clarity comes in. Mm-hmm. And it was net of bad debts. Well, okay, it's net of what's bad debts? You go in the legal agreement, find the definition says bad debts. It's like GAAP, based on GAAP and historical, blah, blah. Okay, and I'm like, that's the worst definition I've ever seen. I went in and I said, well, let's make this, I hate to say it, but I say baby language. Anybody can understand it. It shouldn't be highbrow accounting language. And the attorney was like, yes. And I said, well, if we're still trying to collect it, it's not considered a bad debt. So I put like a paragraph around this. And the kicker is that 4 months after close, and the seller at the time said, Holly, do we really need to care about this? I go, oh yes, we care about this. Oh yes, we do. And 4 months after, he calls me, he says, accounting has changed bad debt. They're writing everything off. They're taking 90. Anyway, they had changed the whole thing, hundreds of thousands of dollars.
Wow.
And I said, well, you don't care because your definition is different than accountants. Actually, I think the accountants are doing a good job. They should reserve more. Great on them, but you don't care. I said, but this is the time you go back up to the mothership of private equity and you say, here's what's happening. I don't think that is anything that I have to worry about. And they said, yes, you're right. And so you have that cadence, you don't wait. And that's the issue with earnouts. The cadence, the control, the clarity, it's a big deal.
Yeah. Absolutely.
That's a crime scene. That is a big crime scene.
Yeah, that small change in that clause probably saved that person a lot of money.
Yeah. He was very grateful. And he's like, now I see. I mean, at the time when you're working through, it's emotional. You're working through all the issues in the agreement, and you have this stupid little bad debt that's in there, and nobody's wanting to give on it. Like, you start giving. I mean, that's the natural thing. I'm like, no, we're holding steady on this. We're holding steady. So we did, and I'm glad we did. Now, I had no idea that was going to happen, but it's a good representation of, you don't know what's going to happen afterwards. So that legal document, that legal language, having a great M&A attorney will help you avoid some of the crime scenes. So that gets me to crime scene 5.
Yeah, we're on to number 5 now.
Yeah. 5 is integration. Okay, long live the humans. Nobody seems to think about integration until we close, because everybody's focused on price and getting through diligence. And the reality is, you're going to have a crime scene if you're not dealing with diligence or dealing with integration, because from the very beginning. So from the very beginning, and sellers, most sellers right now, this is why you care, other than keeping your legacy. Most sellers are rolling over part of their equity into the new company.
Right.
And so you want that new company to be successful. Oftentimes, if you roll over your money in the new private equity, when they ultimately sell, you actually get more money the second time than the first time. So you are invested in making
Because the
sure
values increase. That's the general idea, right?
Exactly, right? So as a seller, you should be holding your buyer's foot to the fire that they need to be thinking about integration from the very beginning. So what does that mean? You're looking at who's important that you need post-closing. You're always thinking about systems, processes, people, and creating that plan as you go. And oftentimes in big companies, you've probably seen this, is the person that's in charge of integration really isn't part of any of the negotiations, or they're talking to the founder, and you've got siloed information.
Yeah.
I used to, because I always was part of the kickoff team, but I didn't have to physically go integrate the companies. So I would actually create a list of what I find that somebody else is going to, that we're putting into a plan as we go, so that the person we're going to hand it off to has the information. So that's a big deal. And buyers have to come to the table at closing and talk to the employees. It's important. Your employees, your humans do not care about your deal. They care about their insurance. Do I have a job? What does this mean for my opportunities? Like, am I not going to be promoted now? I closed on a private equity, or not a family office deal, and we went on the buy side. We went to see them as an accounting firm, and the partners had told the next leadership level in line, which we were excited about. It was part of the multiple we paid. They said, well, we've sold the company. 2 days before we show up, we find out they were promised partnership. Oh. And so, so we were looked at very poorly. We lost one of the leaders, and then we hustled and did all the things that you need to do as a buyer, but we were under the hustle, under the gun, versus planning for that. I believe my buyer could have known that earlier if they investigated. So integration, you need to think about it at the same time you're thinking about price and all that. Oftentimes that information about who's important, who needs an employment agreement, needs to get in the LOI. So you got to back that up to the very beginning. That is our 5 crime scenes.
There we go. There's a lot of them, and imagine situations where sellers may fall victim to all 5, or like 4 out of 5, or 3 out of 5. Like, what a difference that would make to them.
It does make a difference. It is literally millions of dollars of difference.
Yeah, certainly something worth chasing and pursuing. You said something in our first conversation, and we're in, even though we practice very different crafts, we're in this boat together, right? That both data and accounting are treated as back office, like in the plumbing. We're all about the sales and the marketing and the revenue and the profit. But you feel, and I do as well, that data and accounting should be front office functions, or thought about front office functions. So in a world where, like, as you said before, 70% of deals don't actually go through, and often accounting and data are at the root of that, what does it take, do you think, for people to move what we do to be more of a front office function that drives a multiple, rather than being thought of as some cost center that runs in the background and just sort of works behind the scenes?
Yeah, that's a funny question. So yeah, we did talk about that, and it goes back to I was plucked out of CPA firm by my client, and when I interviewed there, they said, "We're going to sell. Do you still want to come?" And I didn't know this, but they were plucking me out of public accounting and utilizing me as a tool for them to grow their EBITDA. So that meant a couple things. That meant getting their data right. It meant having proper accounting. And I was laughing thinking about this in terms of we were expanding, and the CEO said, "Hey, I made your office as big as mine," and I put it out front. So I was literally in the front
Oh,
office.
you were front office. There you go.
I was, and he goes, "Look how big I made your office," and he was touring me through there. I'm like, I don't need this like this big office, but it was cute. So I did end up in the front office, and that wasn't on day one. I got that front office. I earned it because I didn't at the time. I don't think when you're a CPA, you don't actually learn how to maximize value and sell a company. I was in as a CPA in a CPA firm for over 10 years. So get that out of your head. It doesn't work. And so I learned it by actually doing it. But that is what we did. So I think becoming a part of the front office is really about getting the correct data, having the right numbers, using numbers as leverage. So what I didn't understand at the time was we use generally accepted accounting principles, and they're gray. That's why, again, I say be careful on language when you start using that GAAP word, because most GAAP is gray. People think of it as like, okay, this is a hard rule. It's really not. You can find the gray area. So they hired me to find the gray area and produce more EBITDA for them. And when I came on board, you've been there before. None of the data matches. You have somebody in the back office, like, I don't know, it was whatever it was at the time. Yeah. But they weren't giving me proper data. And so in the middle of the night, I'm going through reports. But that was part of the process. And I think once I proved my chops, I actually really legitimately ended up in the front office, which is funny to me that we had that conversation.
There you go. That's where we belong. That's where we belong. Right?
That's where we belong.
I love that. If there's a founder listening now who's maybe 12 to 24 months from what they think is their exit, other than buying your book, Find the Missing Millions, available in all good bookstores and the bad ones as well. What's the one thing, if they made the foolish choice not to buy your book, like what's the one thing you tell a founder who was planning a sale in the next couple of years? What's the one thing they could do that had the most effect?
Yeah, the one thing they could do is go back and start with the foundation, their financial story, their data. They have to go and look at the full story. Most founders, I find, don't even look at their balance sheet. And so that's a problem, because most of the time the problems on the balance sheet actually reduce your EBITDA. So you must go look at your balance sheet, look at your financial story, hire somebody. Oftentimes you don't have, your accountant is compliance based. So they're not designed to help you. So go out and get help. If you do have the ability to afford your own quality of earnings, that's what a private equity company does. You can get your own quality of earnings, and they'll come in and tell you exactly what you need to do. So that's another way to do that, is to get some professional
almost like
help
a dry run before the sales cycle happens.
The smart sellers do that. It's expensive, so you're looking at, low 15, but usually 25,000. So some depending on the size of your deal, it doesn't make sense to do that. But if you have a big size deal, it does make sense. Get outside eyes to help you with your story, because as founders, that's something that I think is the reason why we have so many bad statistics. And if you do want to sell, and there's so much opportunity right now for people that are needing to sell, that will be money well spent. You'll get a exponential ROI on that.
Yeah, absolutely. And and of course we need to keep our compliance-based accountants in the background as well. Like, I'm very grateful for mine, for sure. But keeping the IRS out of my way.
For sure. All of that is very important. Exactly. So we don't want to discount them. Yeah, for sure.
Make sure we're following the rules. And what about the PE firms, right? There's an interesting kind of more ethical angle to this, right? Ultimately, they're running businesses as well, and their objective is to make as much money as possible for their investors. So, it could be argued that it's reasonable of them to pursue any angle, leverage, value that they can get using their experience in the deal as they possibly can. If the PE firms could change one thing about the dynamic, what would that be, or what crime scene do you think they should pull back from?
So I was a buyer in the beginning. I spent a lot of time as a CFO as a buyer, and the one thing that I did that was a bit different is I made sure if money is going into the earnout that it followed my sequence that we talked about.
Right.
I think it's fine for them to go, and if they figure out a way to leverage more money out of that, and the seller hasn't figured that out, that's part of the program.
Yeah.
But I just think, like, I don't know. I'm a softie. When I was a buyer, we would buy, and I'd want you to come into the fold, and I'd want you to be happy, and I'd want you to meet your metrics, and I want you to stay. And so if I found that you were giving away value, me and the CEO, the company, that was part of our ethics, that I would tell you,
Right.
and I would pay you for it. And so I'm cut from that foundation. And so, but I do think business is business, and you don't need to give away value. So I don't begrudge them what they do, but that's not how I operated. So I do believe that the earnout, and it's not that private equity doesn't want you to meet their earnout. So being a little bit more diligent about those three things, and the three C's from a private equity standpoint would be good. So you're not giving anything away. You're just making everything clear. So there's
there's clarity. Yeah.
Yeah, there's clarity there. So I think they could do a better job of that. So I because there's so much risk in there for the seller, it needs to be fair, and they want to hit the numbers too. So you don't want the seller to be demoralized. And so
we want the situation where everybody wins, right?
I think they could do better on that.
Yeah, we want the situation where everybody wins, and I've
Yes.
I've heard stories from friends, and this is more kind of VC land stories than it is private equity, but stories of founders who've taken VC funding, done a brutal kind of year and a half earnout, and then walked away with less than minimum wage for the amount of time that they've put in because of hidden terms or clauses in the earnout, or different definitions that weren't fully locked down that have been used against them. So it's
Yes.
you need to watch out. So I see what you're doing is you're just trying to equip both sides with the right set of information, and people can still give and take in negotiations, right? And some of those
Sure.
things you may give up some of the working capital, you might concede some of the terms on the earnout, but the
And we
important
do
thing for you
sometimes.
is
Yes.
is shared understanding, right?
That's right.
So
That's
that
right.
everyone can get a clear and transparent route to mutual benefit.
Yeah.
I love it. Tell me more about the book. It's out and available now. Like,
It is. It's out and available now on Amazon, Barnes and Noble, and I wrote it because I found that people were struggling and not even knowing that they were struggling. So I really do want folks that are trying, even buyers, it's on the buy and the sell side, both sides of the coin. But I want them to have this understanding before they even get on the path. So they can avoid the crime scenes and make more money, and it's their legacy.
yeah, no, absolutely. And the book will be your legacy, and I'm sure it will help many people, more than are able to hire you. So I think that's a wonderful thing for you to get back to the industry. Where do you think it's all going? I think the trends that I hear talking about industry-wise, the extending hold periods, the returns that don't favorably compare to, the stock market, et cetera, et cetera. Like, there's always some hype headline. The cycle always moves up and down. The impact of AI and that's going to have across all types of work, not just PE-backed companies. What direction do you think it's all going? Like, what things will be different a couple of years from now?
Yeah, I mean, I don't think I'm really even good to answer that, because when I started out, private equity wasn't even at the table. So I was a buyer.
Yeah.
And in the beginning, I mean, was it even 10 years ago? I don't know. Time goes fast. 10 years
It
ago,
does.
they were never there. And then they would show up. half of the time, and I'd be like, okay, they're terrible, come with us, we're better. And so they were always like the evil at the table, and now they're everywhere. And you're right, the returns are not, not maybe there, that are promised, and everything's getting gobbled up. And I don't know. I think it's going to be, I'm not good to say where that's going, but I still think it's a great opportunity for everybody right now. But there is definitely a crisis coming. What do you think about that?
Yeah, one way or another.
Yes.
It's an interesting one. If you think about the impact of the AI technology, for example, like things always roll out in waves, right? So whatever technology it is, like the last people to get it will be the nonprofits and the government organizations, right?
Right.
But the first people to get it will always be the Silicon Valley tech companies, right? They'll be the first ones who figure out how can I turn this into revenue and profit. But private equity is near the front of the line, I would say. Like it and
Yeah.
has always been near the front of the line, but the extending hold periods, the pressure on value creation is going to push PE even more towards the front of the line, to adopt, not just to adopt the technology, but create value from the technology. So I think there's some pretty interesting years to come ahead, for sure.
Yeah.
One last thing I'd love your perspective on. I know a lot of CEOs in growth stage companies, first 5 to 10 years, and many of them see this exit as a holy grail. But I've come across a few unique ones who are like, I am never going to sell, and I don't want to, because I've built a business that makes money for me, that does the things that I love with a team that I love, and I have no reason to give up that annual return that I get from it, to sell it. Can you and speak a bit for the case for the defense of, like, what are some reasons that founders might not want to sell?
Yeah. Well, let me go back to my premise that even if you don't want to sell, you should be prepared to sell. So I think every
I
business
like
owner
that.
should run their company and be prepared to sell. Because what we're saying about that is that discipline of having all of your financials, your processes in order, your leadership team, all of that creates more value for you, because one day you will exit. There is no there,
One
I
way or
mean,
another, we're all
one
exiting.
way or
Yeah,
another, there is an exit.
yeah.
And I've had situations where a founder, unfortunately exits in a way that they didn't know, and then their family's left with what do I do with this?
Right.
So and then they can't, and this has happened. Or I had one case where they came to me where the founder had dementia, and it was progressive.
Oh, that's
And so
terrible.
then the wife yes, and it was a mess. And so you must, for your family, for your team, for everybody, run your business like you're going to exit. You'll have better information so that you can make better decisions, so that everybody's having a better time. You can bonus your employees, you can take great vacations, but be prepared to exit. So my case is really just be prepared to exit always, and you're going to have a better run, disciplined company that actually will be your legacy. So one way or another, there is an exit.
Yeah, and that's wonderful advice. I think a lot of people listening should take that to heart, if they're founders. And
Thank you.
the paradox that I always stay close to, that someone told me, was the businesses that are most attractive to buy are the ones that the founder has built such that they don't want to sell them, right? So if the founder can
Yes.
sit back and just generate cash because everything's well documented, their data's locked down, their accounting's on point, and the business just generates money, like, yeah, why would you sell that, right? Because
Right,
there's
right.
income coming through from this thing, which, because of my great work as a founder and CEO, is no longer dependent on my personal involvement to succeed. So why would I sell it? Then you start to get the temptation, right? Because those businesses are the valuable ones.
Well, it is, but and then I'll just add to that is that a lot of those businesses, AI is disrupting everything. So you say, "Oh, I don't want to sell it. It's going great now." But like sometimes those folks aren't the best people of coming in. they're not the people at the front of the line of getting AI. They're not the private equity. They're down the line of getting AI. And so then their business becomes less valuable. We're looking at the legal market, and law firms haven't been able to sell to private equity. That's sort of changing now. There's some ways to do that. But they're all concerned about how AI is coming in and whether they're more valuable today. Should I sell today versus... So a lot of founders were like, I hadn't even thought of selling, but I'm like, now I'm looking at this whole situation saying, maybe I should now. This is my time. And these are people in their 50s or whatever. I mean, they're not in their 70s, 80s. These are people in their prime, like 50s, I hope is the prime.
I agree.
And so, yeah. so anyway, that is a situation that I think is disrupting those minds right now of sellers saying, yeah, I don't need to sell right now. We're cash flowing, and those are the most positive. You will get the highest multiple for the ones that the sellers in Jamaica and the whole team is creating the cash flow. Those are the most valuable. But is that sustainable? And what is AI going to do? And so I think all of that has to be analyzed when you're making those decisions. And I'm seeing folks that would never be at the table thinking about that differently now.
Yeah, and the other gotcha that I've come across in my analysis of these deals and how they go is that you could be a great person for building a company from 0 to 1 or 1 to 10 million, and it takes a different skill set and a different team to go 10 to 100. So actually, if you think about some of those earn-out clauses, like if you do a smart earn-out and take equity and hand it over to a team that's better able to take it 10 to 100 rather than your team, you could end up with a lot more money in your pocket for a lot less work, actually.
Oh, yeah. I mean, that's the facts. Yeah, that's true. Yeah, absolutely. Yeah, most businesses actually don't get over only 7% of the businesses get over $1 million.
Oh,
that's it. And only 40% of them are profitable. Think about that. The odds are really stacked against you even getting to $1 million of revenue. I'm talking about, not even profit, revenue. Yeah, it's crazy.
Yep, it's a hard road. It's a hard road. Holli, back to the book as we close. You said people can find it on Amazon,
Yes.
Barnes & Noble, other places. What about people who want to find you and continue to stay connected with you as you dispense this invaluable advice out into the world? Where's the best place to find you?
Yeah, they can find me on LinkedIn under my name, Holli Moeini, and social media, both places. And if they want to reach out and contact me, I'm happy to interact. And yeah, thank you so much for having me on your show. I always enjoy speaking to you, and you have the best questions. And so I love all the data, and thank you for all the work that you do and what you're doing out in this community. Thank you so much.
Yeah, much appreciated. Thank you for taking the time, and I'll see you in the front office somewhere soon.
I love that, front office.
I love it. Thanks so much, Holli. Take care.
Thank you.
Thanks for listening to the PE Data Guy, the place where private equity meets data. Please forward this episode to your favorite private equity friend. Thanks for listening. See you next time.